Okay, hi everybody. In today's training, we have Jesse Montez with Rogers Benefit Group joining us to help me cover some of the basic ins and outs of medical insurance. So welcome, Jesse. Thank you so much for taking the time today to be with us.
Thank you, Shelley.
All right, so let's get started. Okay, so medical insurance policies for employers in the small group market are usually either considered fully insured or level funded. And pricing is based on who is enrolled, not who is eligible to enroll. So for you to understand this concept, think about XYZ company who has 10 employees ranging from age 26 to 64. When the agent receives the original census, it includes all 10 employees, and the agent presents a proposal including those employees' demographics. However, upon enrollment, it appears that only 4 employees and 3 dependents elect coverage. This is definitely a dramatic change from the original census that did not include any dependent information and many less employees. So the price may change dramatically. It is important to communicate this concept to the employer and set reasonable expectations. And this may mean that you run through several iterations of proposals to predict a more accurate plan pricing prior to enrollment. And if the company currently has medical insurance, it's always best to submit their current enrollment census when requesting a proposal in order to get the most accurate rates. So what is the difference between fully insured plans and level funded plans? Well, with the fully insured market, there's no medical underwriting required. The renewal rates are based on the community's claims history of a demographic area rather than the claims history of the employer's members, as well as the age of the employees and the number enrolled. Now, level funded, these types of plans are medically underwritten, and its renewal pricing is usually more claim sensitive on the group rather than looking at the whole demographic area like the fully insured plans do. Now, prior to implementation, each employee is required to fill out a medical questionnaire that inquires of their medical history, prescriptions, physicians, hospitalizations, and more. The information collected is used to prepare plan pricing tailored to the group. And some groups may be approved, declined, or even approved with a higher rate than originally illustrated. Now, this level funded option is best suited for moderately healthy groups and can offer a sizable reduction in premiums compared to that identical plan on a fully insured plan. And in some cases, there is even room for the carrier to rebate a portion of the claims funding account at the end of the plan year. For example, Allstate will give back 50% of what is in the group's claims funding account at the end of the runout period, which is 6 months after their plan year renewal. And with Cigna, they will rebate 2/3 of what is in the claims fund account at the end of the group's plan year, typically the 3rd month after their renewal date. Now, in the mid to large group market for both fully insured and level funded plans, the rates are based on claims usage in the prior year. And this information can be obtained by requesting the HB 2015 Tier 1 report, which is a list of monthly claims for the last 24 months, and then the Tier 2 report, which is a list of claims that are exceeding $15,000 in the last 24 months. And these reports can be requested from their existing carrier and submitted along with their current enrollment census to the quoting carriers to receive firm rates. Health apps for level funded plans in most cases are not required by the carriers in the mid to large group markets. However, there are some carriers like Aetna that do require health apps for all Virgin and PEO groups. All right, so we're going to kind of dig down into some insurance terminology. It's important to know the meaning of the terminology insurance carriers use when it comes to the medical benefits. And it's important because they play a big part in understanding how the insurance works and how services are covered. And understanding the terminology and educating our groups on this will help them to choose the best plan or plans that meet their medical needs. So first we'll start with the deductible. It is the amount you must pay before the insurance starts to pick up the tab. There are instances where the deductible does not apply. for example, for services that only require a copay, such as an office visit or urgent care visit. And there are some cases where you can meet your out-of-pocket and never have met your deductible. All right, so now I'm going to turn this over to Jesse, and he's going to explain the differences between the calendar year deductible and the plan year deductible, as well as the embedded and non-embedded deductibles.
Thank you, Shelley. So there are, so we'll start with embedded and aggregate or non-embedded deductibles. Embedded deductibles is perfect. So in a health plan with an embedded deductible, no single individual on a family plan is going to pay more than the deductible, more than their individual deductible. So everybody has to meet their own deductible. When more than 2 people in the family meet the complete family deductible, that's when everybody's, so if you can see the embedded example, as you can see, taking a family who has a family deductible of $6,000, John meets $2,000 of his, Jane meets $2,000 of hers, and then Jack meets $2,000. So then that's how the family will meet their family deductible, but no one person is going to meet more than their individual deductible. So if I were to get hospitalized for whatever reason and I get a deductible of, I have to meet my deductible first, it'll start paying at 100% for me, even though, 2 other people in my family haven't met it. With a non-embedded deductible, the individual deductible limit can only be met by a member and the enrolled of a self-only coverage plan with no dependents. The family deductible can also be met by one family member. So in this, as you see in the aggregate or the non-embedded example, Jack has met $5,000 of his deductible out of the $6,000 family deductible, and that leaves Jane and John to pick up the rest. But it will not start covering for the co-insurance until the $6,000 family deductible is met. It doesn't matter if it's 1 person or 3 people on an aggregate or a non-embedded deductible. And then the other thing is the difference between a calendar year and a plan year. Most of the groups under 100, I would even say under 150, are going to have calendar year deductibles or calendar year out-of-pocket maxes. Those will run from January 1st to December 31st when it's a calendar year deductible. That means that if I have a $6,000 deductible, I were to meet my entire deductible or my out-of-pockets by June. After that, the plan starts paying, whatever, let's say it's 80% co-insurance, I meet my deductible. After that, the insurance starts paying 80% of my co-insurance thereon after until the end of the year. If I meet my out-of-pocket, again, let's say it's a $6,000 out-of-pocket max, when I meet that, the insurance pays 100% until the remainder of the year. January 1st, it resets all over again. Most of the time, as I said, 90% of the groups that you guys will work with, everything under 150 is typically going to be calendar year deductible. Plan year deductible is more for like a self-funded, level funded, or groups that are a lot bigger than that. They're going to be plan year deductible, which means if my policy starts let's say my policy starts March 1st, that means my deductible will run from March 1st until February 28th is the way my deductible or out of pocket will run, and then it resets itself.
Awesome. Thank you, Jesse.
Thank you, Shelby.
All right, so moving on. The following terms also we see on all medical plan designs. Copay is a very common one you see, and it is a specific fixed amount paid for covered healthcare services. And it's common to see copays associated with office visits, specialist visits, virtual and urgent care visits. In some cases, you might see in a plan design a copay required for an emergency room visit after an individual deductible has been met. And then coinsurance, as Jesse was talking about, mentioned, it's a percentage of the bill you pay for covered healthcare services And unlike the copay, the coinsurance is a percentage of the cost of the service. If the medical plan has a deductible, the coinsurance is the amount you are responsible for after the deductible is met. For example, if you see your coinsurance as 20%, that means the carrier is covering the remaining 80%. And if the member receives services from an out-of-network doctor and the plan has out-of-network coverage, the member may be responsible for additional charges above the in-network coinsurance amount. Typically, the out-of-network coinsurance percentage is much higher than the in-network coinsurance. And then your out-of-pocket maximum is the most you can pay during the calendar year for the share of the cost of covered services. What you pay towards your individual deductible and any coinsurance is applied to your out-of-pocket maximum. And the out-of-pocket maximum, however, it never includes monthly premium or health care your plan does not cover. And once you hit your out-of-pocket maximum, the plan pays 100% of the allowable charges for the covered services for the remainder of the calendar year. And then, like as mentioned by Jesse previously, once the new calendar year begins, the out-of-pocket maximum resets to zero, just like the deductible does. All right, so I just wanted to give a quick example of how the medical plans work. So let's take the first example, plan option 1. The individual deductible is $2,000 and the out-of-pocket maximum is $6,000 with 80% coinsurance. So the member went to the urgent care and incurred a medical cost of $10,000 along with their urgent care copay of $55. The member must pay $2,000 towards those services to meet their deductible first, and then the balance of the remaining cost is $8,000, and that's when the coinsurance kicks in. So the member is going to be responsible for 20% of that balance, which is $1,600, and the insurance carrier pays the remaining 80%, which is $6,400. So all that together, the member has paid $3,600 towards their out-of-pocket maximum of $6,000 plus the urgent care copay of $55. And then with medical plan 2, it is a high deductible health plan in which the deductible and the out-of-pocket maximum must be met before the plan begins to pay. And in this case, the deductible and the out-of-pocket maximum are the same at $3,000. So with the same scenario, the medical cost for covered services is $10,000. The member pays $3,000 towards the deductible, which also meets their out-of-pocket maximum as well. And now the plan is going to pay 100% towards the remaining balance. And then any other covered services after that would, should they have to go in and to another hospital visit or anything, would be covered for the remainder of the calendar year at 100%. All right, so let's talk physician networks real quick. So medical plans will typically be labeled as an HMO, PPO, or EPO plan. And these are referring to the type of physician networks the plan uses. And knowing the difference between the plans can help you assist groups to determine the ones that are right for their employees' healthcare needs and their budget. So an HMO, it is a health maintenance organization. And with an HMO, all healthcare is directed through a primary care physician. This plan type requires a referral from your primary care physician to see a specialist. There is no out-of-network coverage, and these plans typically have lower monthly premiums than an EPO and a PPO. Coordinating all of your healthcare through a primary care physician allows insurance companies to offer these plans for a lower cost. With the PPO, which is a preferred provider organization, there's no primary care physician is required. You don't have to have a referral to see a specialist. It does provide out-of-network coverage. However, there are higher monthly premiums for a PPO than an HMO. And having a PPO plan gives the flexibility of seeing physicians without having to worry about coverage. However, if you do choose to use a provider outside of the plan's network, you would experience higher costs than if you saw an in-network provider. And then in recent years, EPO plans have become available. And these plans share similarities with both the HMO and PPO plans, and they're seen as a hybrid of these two types of plans. With an EPO, which stands for Exclusive Provider Organization, the provider network is generally much larger than the HMO plans because this type of plan allows a member to utilize the providers contracted on the PPO network. And in many cases, there are a larger number of physicians included in the PPO network than there are the HMO network. And then this type of plan typically does not require referrals to see specialists, although some do. However, like an HMO, you cannot see physicians outside of the contracted network. It does not provide any out-of-network coverage. And this type of plan usually has premiums falling more expensive than an HMO, but less expensive than PPOs. And EPO plans combine the flexibility of PPO plans with the more stringent requirements of HMOs at a price point that falls between the two. All right, so eligibility. Who is eligible for medical benefits? Well, if you are a full-time eligible employee working 30 or more hours a week or 100 or 130 hours on average a month, you are eligible to enroll into a group's medical benefits. If working less than 30 hours a week, the employee would be considered part-time and would not be eligible to enroll into medical benefits. Now, some carriers, such as Blue Cross Blue Shield of Texas and Allstate, will allow employers to offer medical benefits to their 1099 contractors working 30 or more hours a week in the 2 to 50 space. But there may be additional employer documents needed at implementation for the group to do so. Okay, so employer contribution requirements. To remain compliant, employers must contribute at minimum 50% toward the employee-only premium of the base plan when offering medical insurance. For example, if the group is offering two plans and the employee-only premium on their HMO base plan is $400 and the employee-only premium on their PPO plan is $650, the group would be required to contribute a minimum of $200 towards an employee's coverage, regardless of what plan and level of coverage they choose. They can contribute 50% towards the employee-only premium on all plans if they want, and all levels of coverage across the board, or even to designate a specific dollar amount as long as it meets the minimum requirement of 50% toward the employee-only premium on the base plan. Now, if the employer is offering medical benefits to their contractors, as I mentioned previously, they are not required to contribute toward the contractor's benefits, and the contractor must declare any benefits as taxable income. There is an exception to the 50% toward employee-only rule, and Jesse's going to explain the participation holiday period.
Perfect. Thanks, Shelley. The participation holiday period is going to be, it's one time a year. It's going to be for fully insured groups. This got started when Obamacare first kicked in. It was one of the, that's when it originally started. Normally, the enrollment period is from November 1st to December 31st. Now, this is only on the fully insured side. Level funded carriers don't offer this. Self-funded programs aren't going to offer this. So your big carriers that are going to do this is going to be Blue Cross and Blue Shield and Baylor Scott and White. UHC does it as well. But this is going to be for all new groups enrolling for a 1/1 effective date. Again, the time period to submit paperwork is November 1st to December 31st for a 1/1 effective date. This is when the carriers turn a blind eye to the 50% employer contribution and the 75% participation. So essentially, as an example, I can have a 10-man group, 9 people say I don't want the coverage just because I don't want it or I can't afford it. I don't really have a valid waiver, and only the owner enrolls in the program, only enrolls in the policy. Blue Cross will approve a group during that time period, during the participation holiday period. So it's not just contribution, it's also going to be participation. So carriers will turn a blind eye to that. So if you have those groups that are, struggling to get participation, that would be the time to do that.
All right. Thank you,
Now, there
Jesse.
are no,
Oh, go ahead.
one thing I was going to say is there's no exception. I mean, there's no extension to that December 15th deadline. If we don't get the paperwork by then, they will not get approved for the participation holiday. Now, one thing I do want to mention too is Baylor Scott and White has a very quirky rule with their participation holiday. Something to keep in mind is, so Baylor Scott and White will do a one-person group, right, during participation holiday. However, they will term them the following year. So we enroll somebody January 1st of 2023. Come January 1st of 2024, Baylor Scott and White will term that policy. However, you can rewrite that group again with Baylor Scott and White during that participation holiday period for a 1/1 effective date all over again. Just a weird rule that they have. Blue Cross, once you enroll them, you can leave them on there. You just renew as you have. So now, one other thing I do want to mention is during participation holiday, if you start off as a 1/1 and then you move off of that 1/1 effective date a year later, whatever, then at that point, the employer does have to start contributing the 50% to that group.
Awesome. Thank you, Jesse.
Thank you. Yeah.
All right. So with every medical policy, there are set enrollment periods and grace periods. An enrollment period is a window of time during the year when an employee can enroll or make changes to their current enrollment in their company's health insurance. And this takes place annually, usually a month or two prior to the group's plan year renewal date. For example, if the group's plan year renewal date is April 1st, their enrollment period, which is called open enrollment, would take place sometime at the end of February or first part of March, and enrollments and enrollment changes would take effect April 1st. Now, let's say using the same scenario, an employee does not make their elections during this open enrollment period for whatever reason. There is a 30-day grace period from the benefit effective date of April 1st in which this employee can still enroll or make changes. So that would mean their enrollment could be submitted to the carrier on April 30th with a benefit start date of April 1st. However, it's not recommended that an employee wait that long because this means that the employee and the employer would be paying for a full month's worth of coverage that the employee was not able to use in the month of April. If the employee does not submit their enrollment within that 30-day grace period, they would then have to wait until the next annual open enrollment period to enroll or make changes. There is also called what's called a special enrollment period, which is a time outside of the annual open enrollment period that requires a qualified life event to add or change coverage for yourself and or your dependents. The following qualified life events, or for short QLEs, will allow you to add and or drop your spouse, and or children within the first 31 days of the event. And that would be something such as marriage, divorce, legal separation, birth, adoption of a child, or change in a child's dependent status, the death of a spouse, child, or other qualified dependent, commencement or termination of adoption proceedings, change in spouse's benefits or employment status, and then loss of eligibility for other coverage. Changes are effective the first of the month following the qualifying life event date, with the exception of the birth of a child, adopting a child, and gaining a medical support order, in which the coverage is then effective on the qualifying life event date. So, like for instance, with birth of a child, their effective date is going to be the date that they were born. Okay, so now Jesse, you're going to fill us in on the new hire waiting periods, such as like what's the most common, and then are different waiting periods allowed, that sort of thing. Are you there, Jesse?
Yep, I'm here. I was talking away.
Oh, goodness.
I muted myself. Sorry. Um, Most employers typically have a new hire waiting period before the start of their health insurance benefits to allow time to ensure that a given employee will be a good fit for the company and will likely stick around long term. The waiting period can be set where benefits begin first of the month following their date of hire, or first of the month, following 30 days, 60 days, with a maximum of 90 days. One exception to that would be Blue Cross and Blue Shield. They do offer a 15th of the month, but as far as the waiting period, 30, 60, or 90 would still be the most somebody can be on a waiting period. Oftentimes we do get asked by the employer, what should we set our waiting period to? What do most employers set their waiting period to? Ultimately, it is up to the employer, but oftentimes, we do let if an employer has high turnover, we ask them to set it out a little bit longer, 60 days, 90 days, that way they can make sure that employee is going to be a good fit. If they don't have a lot of turnover, shorter waiting periods are what we do, what we tell employers to offer. 0 days, so I do want to be clear on this, so there's a difference between date of hire and then 0 days following first of the month following 0 days. So date of hire would be if I am hired February 12th, that means my benefits start February 12th. As to where first of the month following 0 days would be I start February 12th, but technically my benefits will not start until March 1st. Okay, so I do want to make sure that, because Blue Cross is now offering that piece of it, a lot of the ancillary carriers have been offering date of hire for a really long time. So some people think, I don't start till March 1st, but then that also runs into what Shelley was talking about earlier with open enrollment periods and things of that sort. So you got to be very careful when it's 0 days, first of the month following 0 days, or the exact date of hire, because then your period changes a little bit. So that's going to be the three biggest differences as far as waiting periods. Most carriers only offer up to 60 days with a maximum of 90 days. And what I mean by that is if I'm hired, let's say somebody has a 60-day waiting period, but I'm hired February 2nd. That means I would go February 2nd, March 2nd would be 30 days, April would be 60 days, but then the time between April and then, February, March, April, and then May 1st, I'm going to be really close to that 90-day waiting period. So that's the reason most carriers just say 60 days is the most that they offer. Humana used to be the only medical carrier that would let you go all the way to a full 90 days and let you enroll on that 90th day.
Right. So Jesse, I do know that Allstate, they allow the groups to do a 90-day waiting period, but in that case, once the employee has met that 90 days, their benefits start immediately. So they do allow you to set that. Yeah. And then with Blue Cross, they will allow you to add like an additional 30-day orientation period onto that 60-day new hire waiting period as well. If an employee is wanting to, if they're wanting to make it 90 days, that's one way that groups get around that with Blue Cross.
Correct. Yes. And just so you guys know too, a lot of the people that do the orientation period, those are a lot of the clients that I see do that are going to be when they have a sales job and they go through a 30-day training program before they actually consider employees of the company. Like they have to pass certain guidelines. That's the reason I sales jobs do that. And then a lot of the like the HVAC people, like they say, hey, you have to pass this 30-day whatever test we do, and then they start, then they'll start you off. So that's a really good example. Thank you, Shelley.
Yeah. All right. So can employees have different waiting periods?
Oh, that's a great question. So as far as different waiting periods, so in the 51 plus segments, bigger groups do have different options. Now that's got to be classed out depending on the groups themselves. So it can be executives versus non-executive employees. It can be salary versus non-salary employees. In the 51 plus market, you can have different waiting periods or different classes of employees. In the 2 to 50 space, unfortunately, you only have one waiting period and everybody has to abide by that. Now, One thing I do want to mention too is some people try to change their waiting period mid-year to accommodate for a new hire that they may have had. Some carriers do allow you to change your waiting period midway through your policy. However, anybody was hired prior to that request. So let's just say I was hired February 12th, and I'm doing I'm doing a waiting period change for March 1st. I still would abide by the waiting period that was set before the new one kicked in. So if it was a 60-day and I'm trying to change it to 0 days, because I was hired before March 1st, I would still have the 60-day waiting period. So.
It's awesome. We've had a few groups that have done that.
Yeah, and then they think that they can get around that, but unfortunately they cannot. But yes, 51 plus groups would be the only ones that would allow different waiting periods that I've noticed. So
awesome. Well, thank you, Jesse,
thank
so
you,
much. That wraps up our training for today. I appreciate you joining us and giving us a wealth of information.
No, I appreciate you guys letting me be a part of this. Thank you.
Yeah, thank you so much. All right, well, you guys all have a great rest of your afternoon.
Have a good evening. Bye.